Hello, everyone, and welcome to another episode of the Famvestor Podcast. I'm your host, Sunny Burns.
And I'm your co-host, Sunmarie Burns.
Today, we have a really exciting episode. We are talking with Annie Dickerson, and she's telling us all about syndication deals. But it's not, her story is really interesting. You know, she started out just 23 years old, married, graduated college, and they just decided to buy a duplex from the whim of a realtor telling her, you know, you could live mortgage-free, property tax-free. And they went from that duplex to another duplex on that same block, and then they moved from Washington, D.C. to California, where they bought 2 more duplexes, and then did out-of-state rentals in Arizona, now having a total of 30 units. And then in the midst of all that, having 2 kids and just realizing, you know, maybe it's not worth doing all these individual investments, but finding out about syndications. And that's when she really found out about how you can passively invest in real estate. And now with her and her business partner, they've created this investment company called Goodegg Investments, where they help others invest passively in real estate syndicated deals. So that's just putting in some money, but you're not putting in any work, you're not swinging any hammers, and you're probably not even choosing paint colors. It's really just investing some money into the deal and then gaining some returns in return.
I love her story. I love how she just goes very naturally through this progression of being dependent upon the 9-to-5 type of lifestyle and not really thinking outside the box.
Right, she was a teacher, her husband a software developer.
And that was just the way life was. And then bit by bit, these little light bulbs start going off, and they take another brave leap and they try something new and it works. And it just leads down this progression to where they are today as multifamily syndicators. And also the freedom that's brought in, or more so the flexibility it's brought into their lifestyle.
Right. We take a cool journey through her latest home exchange, where she exchanged with another family from Spain. They spent a month in Spain, and then that Spanish family spent a month in California in her house, and they didn't pay anything. They used each other's cars. They both had 2 kids each, so the car seats were all equipped, and it was just a cool cool thing that we want to check out for the future.
Cool way of traveling outside of the norm.
And no housing expense. You got your full kitchen. You got transportation covered. Just seems like a really great way to travel.
Right. So it's a fun episode. It's interesting. You'll learn a lot about syndication, but also about the more personal side of living life intentionally.
Right. Speaking about travel, we just got back from a trip to Ohio for a wedding, your cousin's wedding, and it was a 7-hour drive to Ohio and back, and we drove it.
Yes, it was, and not that bad, actually. 4.5-year-old and a 2.5-year-old, I think most people would think, eek, you're going to drive that? But, yeah, it went really well, and here's how we did it.
Yeah, and I guess the reason we'd like to do that, I mean, I guess the alternative is take like a 2-hour plane ride or an hour plane ride, but then, you know, you're paying for both kids, and now it's quite a costly endeavor all of a sudden.
Right.
And what we like to do is we just set out late at night. So when did we leave? Actually, we left early in the morning, 3 a.m. 3 a.m. And by the time it was noon, you know, we had already arrived, and the kids were sleeping in the car. Sunmi took a nap first shift, and then she drove the rest of the trip while I took a nap. And it was just a, you know, economical, easy way to get down there.
Yeah, driving through the night or setting off early in the morning does help, because the kids will usually fall back asleep in the car, and then it gives you peaceful time driving so that you don't have a lot of blabbering in the back seat and distractions. You can kind of just drive and focus on the road.
And you know, flying gets costly, because then at the end stop, you got to rent a car. You got to rent the car seats, which are usually $9 a day, and it just all adds up. So I don't know. We're, like we said on every episode, we're just very frugal people, and it's been working for us. We have a trip going to Florida in 2 months, where we're going to do that 17-hour drive. We've done it before with both kids. They were a little younger, but, you know, we love play audiobooks. So sometimes we go to the library right before and get those kids' audiobooks that, you know, it gives a
Comes
little
on
ding
CD.
noise, and then they flip the page.
They
But yeah,
love
it's on
that.
the CD. And then we also downloaded from YouTube the audio files of all their favorite read aloud kids books that we can just play on for them as we were driving.
There's also a bunch of great podcasts
Yeah,
out
the
there.
Stories podcast they've been loving recently,
Right.
where it's like a folk tale every episode, like a 15-minute folk tale episode. And they just love listening to that. And we have toys for them in the car, the water pen. We've mentioned that before. And usually you pack some brand new toy for them or a toy they haven't seen in a couple months.
Right, so that, at some point when they get bored of everything else we have, we whip out a new little car or something, and then they'll be occupied for another hour just playing in their seat with their cars.
Yeah, honestly, they did surprisingly well that whole
did.
trip. And I think it's just because we were intentional about having all these tools to change up the scenery in some way of, whether it's a new audiobook, a new podcast, a new toy they got to play with. And then just
We did pause for breakfast at
a Playhouse, McDonald's.
a McDonald's, which had a play place, and that helped too, to just let them stretch their legs and take a break for a bit in between the drive.
And honestly, I'm glad we did it that way.
Yeah.
It really was not bad.
No, it wasn't. So don't be afraid. Don't be afraid of traveling with little ones in a car for a long time. It is possible.
Right. Anyway, with that, let's hear this wonderful episode with Annie Dickerson.
You're listening to the FamVestor Podcast. If you're looking to raise your family with intention, gain financial independence, and live a life of true freedom, you're in the right place. Join us as we explore together how to create thriving families, because strong families are the cornerstone for a world at peace.
Welcome back to the FamVestor Podcast, everyone. Today I'm very excited to have a really cool guest on our show. We actually go way, way back, all the way to elementary school, although we didn't know it at the time, but we went to the same elementary school just a couple years apart, and then we recently met up in person at FinCon in Washington, D.C. recently. But let's all welcome to the show Annie Dickerson.
Thanks for having me.
Thanks for being here. Yeah, so cool that, we used to be classmates, sort of.
I know, it's so
Same
crazy.
teachers, almost.
And how'd you know that I lived in Fort Lee?
I think it was on your Facebook. I must have stalked you. And, it was probably the background check that I did on you.
Yeah, because I'm trying to think.
No
We
idea.
lived in Fort Lee, then we moved to Dumont, then Little Ferry, then Moonachie. So we've been all over the place in northern New Jersey here. But,
Similar to you, he moved around a lot as
but yeah,
a kid.
10 years in Fort Lee. We went to the same elementary schools, had some of the same exact teachers. We talked about Mr. Novembre, who used to poison his squirrels and go on rampages against his squirrels.
Oh.
He was a cool teacher, but
He was a
Sound
really
cool.
cool
he was
teacher.
vindictive against his squirrels who ruined his garden.
I'd have a problem with him because I like squirrels.
Anyway, Annie, we're glad to have you on the show. I guess just to begin, a little bit more of your backstory and how you got started in all of this, and whatever you want to share in regards to family, finance, and freedom, and the life you now lead. Where does your origin story kind of begin? Like, what got you into the mindset of buying that house hack with your husband? Where were you at?
Wow, that's a heavy question right there. There's a lot of parts to that question. I guess I'll start from the beginning. Growing up, I never thought I would be a real estate investor. It just never crossed my mind. All growing up, my parents never even bought a house. The whole time I lived with them, they always rented. We always lived in apartments. And it just we never talked about growing wealth and passive income in our household. And it just never occurred to me that those rent checks we were paying every month actually go somewhere.
Right.
I just thought that's just the thing that we do. We live in these apartments and we pay rent every month.
Right.
And I still hadn't put two and two together. After college, my husband and I got married, and we were looking for our first property. We'd saved up a little bit of money. We were living in Washington, D.C. at the time. And we thought, let's do the hip thing. Let's buy like a condo in Adams Morgan, or let's buy a loft. And we were looking at all these trendy spaces, and our realtor said, these condos are nice, but have you thought about a row home? And in DC, these row homes are pretty common. They're like townhouses, one right next to each other. And often in these row homes, you have 2 units. You have the main unit, and then you have a basement in-law suite.
Interesting.
And we were like, what are we going to do with an extra unit? We're just 2 people. We don't have any kids. And he said, yeah, but you could rent out that in-law suite. And if you play your cards right, eventually you could get this thing to be cash flow positive. And I had never heard anybody say those words together, cash flow positive. I didn't know what it meant even, but I was like, I need some of that.
That's a good realtor right there.
Mm-hmm,
Yeah, not paying rent, not paying a mortgage or taxes even, hopefully.
Good advice, yeah.
So that was our
cool.
first property, was that duplex. And as soon as we realized how it worked, we then went on to house hack more duplexes. And in fact, we're still living in a duplex right now.
That's
Nice.
awesome.
So you found your journey to be through duplexes. How was the condition of it when you first bought it? Was it a fix-it-up special, or it was pretty ready to be rented out?
You'll appreciate this. We had been looking for a few weeks and couldn't quite find the right property. And one night, my husband was out with his friends, and we were early in marriage, and he didn't communicate with me how late he was going to be out. And I was just passively aggressively stewing over here. And I'm like, you know what? I'm not even going to go to bed. I'm going to look at some listings. And as luck would have
Sounds like
that night, I found the listing for that first duplex we bought.
Oh.
And what struck me about it was, even though the condition was okay, but it needed a kitchen remodel, and the downstairs unit had previously been a brothel, so there was some work to be done. But what struck me was the view of the main space. Like when you open the front door, you have this beautiful exposed brick wall going all the way down one side of the house. And that was what sold me. So we went there, we saw the condition of it, and we thought, this is just enough work to where we can, without kids, we roll up our sleeves and do some work, but it wasn't a heavy lift. Like it didn't need foundation work and roof work and things like that.
Right.
Wow. And what year is this when you bought that duplex?
This was 2008.
2008.
We got real lucky.
Wow. And how long did it take you to kind of get it rented? Did you fix the rentable unit first, or where you were going to live?
We renovated the unit that we were going to rent out first.
Okay.
And so that took probably 2 months, I would say, 1 to 2 months. Of every evening, every weekend, we'd be at Home Depot or we'd be working on the unit.
Sounds familiar.
And then our first open house, we had never done an open house before, and we got all these balloons and we made it this whole big thing, and then it poured down rain.
Oh no.
The whole time. But we found some great tenants for that first unit, and they're still friends of ours to this day.
That's awesome.
The people who are willing to come out in rain are the ones who are serious.
That's
And
cool.
they came out on their bikes.
Oh, that's so cool.
They were really serious.
That's cool to hear another person doing open houses, because that's the way we like to do it. But
Yeah.
I've never heard other people doing that. So cool.
Yeah, very cool. So, when you first get into real estate, you soon learn that Home Depot will be your favorite date night spot. And it's like, what are we going to do tonight? Well, let's go to Home Depot. Maybe we'll brainstorm something.
One of my worst days was going to Home Depot for the 5th or 6th time after, needing to get one other part or something.
Mm-hmm. It's always that one little thing that you left.
Right.
So you mentioned after college and when you met your husband, this is when you went to buy your first house. I'm just curious, what are your backgrounds? What had you been pursuing prior to this real estate moment of enlightenment?
Great question. Nothing related to real estate, I'll tell you that. And we're now both in real estate. So
Oh, wow.
Funny how that happens. At the time, I was teaching. I was a fourth grade teacher with Teach for America. That's partly what we were doing in DC. Mm-hmm. And my husband was a web developer. He was working at the Kennedy Center in DC at the time.
Oh, wow.
Wow.
Yeah, vastly different fields from fixing up houses.
Oh, yes.
And so, were you able to just live for free then? Was it really that dream that the realtor sold you, or was it not? Was it quite not that easy?
We weren't quite there yet with that first one, because I mean, it was kind of the two units were not the same size. So the unit we were living in was 3 bedrooms. And then the basement unit was just 1 bedroom.
Oh, okay.
So we were renting it out for about $1,500 a month, but it wasn't covering our mortgage.
But definitely helped. $1,500 a month. Yeah.
Oh yeah, it definitely helped.
Awesome. And then from there, were you guys like, oh, lights on? We just get another one of these and another one. What happened?
That's exactly what happened. We were like, we didn't know about anything like Bigger Pockets, or we didn't think to do research. We were just like, oh, we stumbled upon this thing that works. Let's do it again. So we literally bought, the following spring, we bought another duplex on the same block.
Nice.
So we did that, and then, then we moved out of DC, and so now we live in Oakland, and we have 2 duplexes here in Oakland.
Wow.
And then a couple years ago, I was helping my husband, who is now a real estate agent. I was helping him with his website. And he had mentioned that he wanted to help people who wanted to house hack, just like we were. Mm-hmm. And I said, well, I know a little bit about it, but not enough to do your content marketing. So I'm going to have to do some research. So that's when I found Bigger Pockets, that whole rabbit hole, and did all this research. This was about 2 years ago now. And at first, my thought was, okay, well, we have to immediately do another house hack. But then I looked around, and it's crazy expensive here in the Bay Area. And now with 2 kids and all their stuff, it was just a nightmare to try to lug that around.
Right.
So then I said, well, the next best thing, I didn't know anything about syndications or passive investing. I said, the next best thing is, well, let's invest somewhere else. Let's just get a rental property in another city. Right. So I did all this research, and I came across Huntsville, Alabama, as an emerging market that would meet a lot of our criteria. So we started investing in Huntsville, and quickly amassed over 20 units in Huntsville because it's cheap.
Wow.
It's freaking cheap there.
What does cheap mean?
Oh my gosh. The first place we bought was $170,000 for 6 units.
Wow.
6. Yeah.
Ooh.
And then we bought another one. I think it was like $200,000 for 4 units. I mean, it was just like the first time I saw a 4-plex in Huntsville that was listed, I asked the broker, I said, so tell me what's wrong with this property. Is it government projects? Like, is it a fixer? What's going on here? And he said, no, actually, that's a nice area. It's got great schools. That's in good condition. I was like, what?
I need to move to Alabama.
and this whole time, you still both have full-time jobs, or is one of you, what's going on?
Yes. So at this point, both my husband and I still had full-time jobs. He was working as a real estate agent, and I was working as a creative director, creating trainings for companies.
Okay.
When he became a realtor, I must say, I crossed real estate off my list. I was like, we can't both be in real estate. So he's doing real estate. Okay, well, I can do anything but real estate. And it's funny how life just laughs in your face when you do that. Right. So we started investing out of state. And what happened was pretty quickly, our friends and family were like, oh my gosh, what are you doing with all these properties? I want to do that too. And I'm like, yeah, no, come on, I'll show you how to do it. Here's what you do. You research the markets, you find a broker, you underwrite the properties, you go tour the properties, you go fly there if you can. And I list all these different things and I watch every single one of them. Their eyes glaze over and they're like, oh,
Well, it's actually not that
no,
simple.
I changed my mind. So we had enough of these conversations though, to where I was like, so there's all these people we know who want to get into real estate, but they don't want to do the work.
Right.
But we've done the work. We know how to do it. Surely there's got to be some way that we can help them.
Right.
But the only thing I knew were these small multifamilies. And I said, there's just not enough room in a $200,000 property to bring in additional investors.
Right.
And that's when I stumbled across this concept of syndications and group investing. And I was like, oh, well, obviously, if I've done a 4 unit, I can do a 40 unit. It's pretty much the same thing. And I was so incredibly wrong. Could not have been more wrong. But it started me down the path. And what happened was I was starting to do my own syndication. That's what I wanted to do. I was going to do all of it, from finding the property to underwriting. I'd taken these courses. I knew how it all worked.
You are brave.
Right.
I didn't know what I didn't know. I know I was brave now looking back, but at the time I was just like, what's 40 units? And luckily, the universe stepped in and I met somebody who said, well, why don't you try raising some capital for our syndication that we're doing? Mm-hmm. And I said, why the heck would I want to do that? And I said, raising the capital is the worst part of the whole thing. Why would I want to raise capital for your deal rather than my own deal? And, but he said, well, think about it this way. Your investors are still your investors. It's just you're giving them access to these great opportunities that they otherwise wouldn't have access to. And I said, oh, yeah, I guess you're right. And so I tried it for that first one, but I said, you know what? I'm not going to raise a lot. I'm just going to raise a couple $100,000 and see how it goes. And those first few investors, I will always remember that experience because I loved it.
Did you?
I loved talking with investors because for all these months, I'd been learning about real estate investing. And now finally, I got to share what I was learning with my friends and family. And I loved it. That experience allowed me to let go of doing a full syndication myself and just focusing on the capital raising.
That's awesome. So what was that first deal like? How many people did you bring into that deal, and how did you meet this syndicator?
Yeah. So I met that, he was actually also raising capital for this deal. And I met him through Bigger Pockets. Actually, I had listened to him on a podcast and then reached out to him, connected with him. And that's how we got started. And that first property, gosh, I used to know that first investment like the back of my hand, but the details are escaping me right now. I think it was 264 units in San Antonio, Texas. And it was a B-class value add, which means that it was, commercial property is graded on a scale from A to D, with A being the luxury tier and B and C being the workforce housing, and then D being stay away. And so this is a B-class property. And it was a value add, meaning that we were going to go in and do some work to renovate the kitchens, update the flooring, and improve the property overall. So there was that impact piece as well. Mm-hmm.
Wow, awesome. And so you said you bring in passive, family and friends. So they're not actually there with a hammer fixing this place up, right? What are they doing as passive investors?
That's the best part. And that's what I wish I had known before I had invested in all those units in Huntsville. Because even though we have a property manager, I still have to make those decisions of whether to evict people or, whether we're going to do the roofs now or later. All those little decisions we still have to make. Right. But our passive investors, they don't have to make any of those decisions. As a passive investor, you're just putting in your money. Usually the minimum is $50,000. So you put in $50,000 and then you don't have to think about it. So they can just sit back and collect their returns. Most of the time they're paid out monthly, and then they can go on living their lives. They don't have to worry about property management or tenants or maintenance or anything like that.
And so what this first deal that just kind of analyzed it, what year was this in? And if you put in like 50,000, like what kind of interest rate were you getting back, and how long did you have to keep it into that deal for?
Well, I should start by saying I haven't been doing this very long. So I quit my job as a creative director. I quit my job in January of 2018 to give this real estate thing a real run.
Nice.
And I really burned the ships before, I didn't have a plan B. I was just like, I'm going to give it a go. And if worse comes to worse, I can just go back and get another job. But I had quit my job, and then this was January of 2018, and in February of 2018, I had the opportunity to raise for this deal in San Antonio.
Nice. And
so it really wasn't that long ago. It was about a year and a half ago. So those first few investors, I raised a total of, I think, $250,000 for that first deal. Mm-hmm. So I had two $100,000 investors and one $50,000 investor. And this investment it's pretty typical for the investments that we do. It's about a 5-year hold, meaning you put in your $50,000 and you expect to have it in the investment for about 5 years. And during that 5 years, you get about 8% on your money every year, which on $50,000 comes out to about $333 a month. And then on the back end, when we sell, so this is year 5 now, when we sell, this will be, it'll be 2023 when we sell this property, roughly. Then you would get another about 50 to 60% on your original investment. So all in all, we're looking to double your money in 5 years when you count the cash flow and the profit from the sale.
Oh,
That's crazy. And would you say that was kind of like a home run deal, or is that kind of typical in what I know you've done about your company has done about 700 million in transactions or co-transactions for these syndications now. So is that kind of typical, or is that a home run deal?
Yeah, so that first one, I didn't know any better. I was just like, this looks way better than the syndication I was going to do myself. Mm-hmm. So it looks fantastic. And now that we've done about 25 deals now, that one is pretty typical.
Wow.
So usually we're doing over 200 units because that's when you get the economies of scale. And the returns that I just talked about, that's pretty typical for what we're looking at.
Wow, that's amazing.
Is it pretty standard for a syndicated deal that you have a sell plan? You say 5 years and then they plan to sell, or is it ever like a buy and hold and stay in it indefinitely? I'm just curious because I don't know too much about it.
That's such a good question. And there are both. So for our model, we typically do a 5-year hold. And we do a value add. So we push up the value during that time by doing these renovations. And then we give the investors their money back, and then they can do it again. And it's a very quick way to grow relatively quick way to grow your wealth. Mm-hmm. Versus buy and hold, there are syndications that do long-term buy and hold. And it's just slow and steady, and you get your cash flow. every month. So it really depends on your goals and what you're hoping to get out of it.
Wow.
Interesting.
So I kind of want to circle back a little bit because it sounds interesting to me. I know you were a valedictorian of your high school class, and you said you just burned your ships and you left your corporate job. I think you were working for Fortune 500 companies. And so what was the mindset there of, just going 100% for this?
In the 10 years after I graduated from college, I had 9 jobs. 9 in 10 years.
Wow.
And
you moved around.
I moved around. I didn't want to. The funny thing is, every job I started, I had high hopes, and I was looking around at my friends who had been in the same jobs for 3, 4, 5 years. And I was like, what is wrong with me? Surely I can stay in a job for more than 2 years. But inevitably, around the year mark, the 18-month mark, I would just butt up against these processes and people telling me, no, we can't do it like that because this is the way it's always been done. And, I couldn't have the impact that I wanted to have. And now, looking back, I see I was trying to be an entrepreneur in an employee's shoes. And it just wasn't working out for me. I didn't know at the time that I should have been an entrepreneur all along. But I just knew that I was not enjoying my life as an employee at this company I was working at. So I knew I needed to change something, and this was the perfect adventure to begin.
Wow.
So one thing I'm pulling out of your story, it seems pretty consistent your whole life, is that you take action. You're not afraid of making a leap into something that's new terrain for you. Like real estate, it was not something that you were accustomed to growing up. You didn't see your parents doing it. It was a whole new concept, but it made sense to you. And so you have this sort of this self strength or bravery to just say, you know what, this makes sense. I don't see why it wouldn't work, so I'm just going to go for it. And I think that's a key thing for anyone who wants to be entrepreneurial or getting into real estate, is being able to make that decision and go forward with it, even though it's, into uncharted territory for you. And that is really a remarkable thing that I'm hearing in your journey. And also, I guess in your work life experience too, you were feeling after a year and a half unchallenged or kind of held back and not being able to really pursue what you thought was best. So it's a really interesting personality trait to think about if real estate is right for you or not. Are you able to make those leaps? I know Sunny's really good at that, and I'm not so good at that. But I'm supportive. But I've always been kind of like fascinated by that mindset of being able to know yourself well enough. And when you think you're confident about something, just go for it and go for it all the way. And that seems to be something that you do. And that's pretty impressive. Is your husband also like that? Or is he kind of like, all right, Anne, whatever you say?
Well, that's such a good observation. I'm so glad that you brought that up because, sometimes I don't realize that it's a strength of mine and that I don't realize that not everybody does that. But right. I have this on my in my office right next to me right now. I have this row of Post-its with some of my favorite sayings. Mm-hmm. And one of my favorite ones is fail faster. Because that's my motto for life is, you'll never know until you try it, and you can't be afraid of failure because that's just feedback. Mm-hmm. And so that's what I always try to do is just as soon as I can, I just get into it. I try it. I think that's partly what I learned from being in the world of design is you just got to throw some spaghetti against the wall and try it and see what works. Because otherwise we'll sit around all day talking theoretical numbers and, right. Well, what do you think about this deal? What do you think about this deal? But until we actually do it, we will never know.
Right.
But it's so great to hear that you guys balance each other out, because I think if both of you were like, take action, you could probably
be a little reckless, maybe.
Yeah, exactly.
And if we were both like me, we'd never do anything.
Yeah. So my husband and I are a good balance too. He's more of like, I'll come up with the crazy ideas and he'll sort of take a step back. And same with my partnership at Goodegg with my partner, Julie. She is much more like she'll take a good hard look at the bigger picture and the bottom line. Whereas I'm just like, let's go do this conference and let's try this new initiative. And so she's like, wait a second, where are we going?
It's important to have both. I think that's key to successful business relationship or personal relationship, is just to be able to have that balance.
Mm-hmm.
So Annie, you and your husband now kind of share a portfolio of around 30 units, right? Are you glad that you have that now? I know you said, it's a decent amount of work maintaining those. You still have property managers and everything like that. But do you wish that you had just kind of figured out this passive investing earlier and just done that? I know you have 2 kids. Like, what is your thoughts on that?
I think knowing who I am and knowing that I always like to reflect and like I like to take action, I think I always would have wondered if I went straight into passive investing. I always would have wondered, could I have done it better myself? Mm-hmm. Maybe I should try a rental property on my own. But the fact that I've done it, and I even looked at the numbers 1-to-1, like one of my rental properties, one of the better ones, versus one of our syndication investments. And I looked at the numbers over the span of 4 months. And my hypothesis was, surely I'm doing more work for the rental property. Surely I should be making more money. And it was the case for one of the 4 months that I looked at. But the other 3 months, one of them, the 2 options broke even. And then 2 of the 4 months, the syndication actually fared better.
Wow.
And here's why, is because that particular, all of our rental properties we're in the process of stabilizing them. Mm-hmm. And that process, it's been 2 years now that we've been in the process of stabilizing them, because we have tenant turnover, then we try to find a qualified tenant, so it takes time. But in the process, we still have tenants that we've inherited from when we bought them. So those are the tenants who are living paycheck to paycheck, who are paying late, who are sometimes not paying at all, who are vandalizing the property. So with 2 steps forward, 1 step back, it's always 1 step forward, 2 steps back. Is that how it goes? Shoot. Anyway, you know what I mean.
Yeah.
Right.
Yeah, I could definitely see that as an aspect of the personally held real estate deals, is you do have a lot more work on your hands, and there is a lot of setbacks that come up unexpectedly. Even if your tenants aren't causing you problems, you have things break down that were not anticipated and not necessarily budgeted for, and things that can really throw your scope or what you think you're going to bring in that month for a loop. So it's a lot. It fluctuates greatly, and perhaps with syndications, a lot of these things have already been factored into the expenses and the overall plan. So it's a lot more, I assume, stable.
Yeah. So for our personal rentals, it seems like every other week, our property manager's like, oh, I got some bad news. The AC broke down, or the hot water heater's not working, or, this or that. And we're like, okay, how much is it this time? And then we go through the process of getting the quotes, and then we get the quotes, and then we approve the quotes, and then we have to, it's $700 here, $1,500 there. And it really adds up, especially when you're not expecting it. Yeah. With the syndications that we've invested in, when we put in $50,000, that's it. There's no more. It's not like we need to add in $1,000 here, $1,000 there. That's just like, it's a done deal. So it's just such a different, like with young kids in the house, it's just such a better fit for our lifestyle at the moment.
You don't have to think about it. Now, I think there's limited partners and general partners in a syndicated deal. The general partners are the ones who are taking more of that personal risk,
liability.
I assume. So perhaps if they're
Yeah, can you share how like limited
Yeah.
partners, people who are just putting in that 50,000, how their money is protected? I know there's things called like preferred returns. Like how is their money protected? And like if a deal kind of goes a little sour, or maybe some refrigerators do break, and
Where's that picked up?
Yeah.
Yeah. Great question. So there's a few parts to that. So first I'll talk about the liability. So when you invest 50,000 as a limited partner, by definition, you are limited in your liability. Meaning if something goes terribly wrong with the property, you are not held liable for anything beyond that initial 50,000. That's the worst that can happen, is you lose that $50,000, but they can't come after your home or your other assets. Mm-hmm. Versus a general partner who does have more of that liability. So if something were to go wrong, then they would be held more personally liable. Mm-hmm. And then you mentioned preferred return, and you also mentioned, what was the other thing you mentioned? Anyway, let me talk about a preferred return. So a preferred return is one way that your money's not protected and there's not a guarantee, but it's about as close to a guarantee as you can get. So here's how it works. If you were to invest $50,000 with an 8% preferred return, that means that the first 8% of any returns go 100% to the passive investors, to those limited partners. The general partners don't get any of that first 8%. So that doesn't guarantee that you'll get your $4,000 a year, but it's pretty close to a guarantee, because a general partner would never take on a project unless they were confident that they could get at least 8%. Mm-hmm. Because if they're going to offer an 8% preferred return, they're not getting paid until it hits at least 9%. Mm-hmm. So if they're going to take on a project that they're like, maybe it'll be 7 or 8%, then it's just not worth their time.
Right.
And then we also typically factor in what's called a waterfall structure. So that first 8% goes 100% to the passive investors. Then the next tier, let's say between 8% and 13%, then it's a 70-30 split. So 70 to the passive investors and 30% to the general partners. And then if it goes, let's say, above 14%, then it goes to a 50-50 split. So what this does is it really aligns the interests, so that the sponsors or those general partners are really incentivized to make the property perform as well as possible. Because the better that the property performs, the better that everybody does. Mm-hmm. So that waterfall structure is a great alignment of interests and protects your capital in some way, for sure.
That's really cool. Yeah, I never heard of that waterfall.
It makes me wonder why anyone would want to be a general partner.
Well, general partner, if you have like a home run deal, right? I'm sure that waterfall caps that at some point. So anything over that's gravy to the general partners.
Yes. And there is, you have to think 70-30 split, right? 70% goes to the passive investors, but sometimes there could be hundreds of passive investors versus that 30%. Sometimes there's only, 5 or 10 general partners. So it's a bigger piece of the pie.
Mm-hmm. Mm-hmm.
Okay, Annie, so we're kind of talking about cool things, 14% returns and things like that. But let's say, tomorrow the stock market crashes and we're back to another recession. What are we thinking then? You talk about 5 years, we sell a property, but what happens if all like the real estate prices, you can't sell, or you sell at a loss? What happens then? What are the contingencies there? And yeah. Mm-hmm.
So there's two parts. So the first part I want to talk about is, let's go back in time to 2008, the Great Recession. Mm-hmm. The world was falling apart all around us. But then if you looked at multifamily, which is mostly what we invest in, if you looked at multifamily, the performance stayed the same. It didn't change, because you know why? It turns out people like to live indoors. And
Oh, that's
during the
new.
recession, during the recession, when people lost their jobs, what happened was those who were in A class would move down to B class properties. Mm-hmm. It's not like those people just decided, well, I don't need a house anymore. Mm-hmm. They still needed housing. They just downgraded. Right. So in a recession, that B class and C class to an extent, the demand actually goes up.
Interesting.
And so it's actually a fairly recession resistant asset class.
Okay,
which is why we invest in it.
I can see that. So, it's always going to perform, you're saying, from a rental perspective. So you'll still have that rental cash flow going in, and you'll still probably get those same kind of returns. But you're saying, after 5 years, the plan is to sell. What happens with them? Because I'm sure you could be cash flowing, but in terms of the exit strategy of selling might not be there?
Yes, I'm so glad you asked, because that's the other part. So when we go in to an investment, we're always thinking about the exit strategy. And so while we say 5 years, there's a couple things there. So the way that these syndications work is, I mentioned we're adding the value, so we're renovating the property. And the way that we do that is we don't kick anybody out. When we buy a 200-unit apartment building, right off the bat, there's going to be 10 to 20 units that are empty. Mm-hmm. So we start there, we turn those over. And then as people's leases come due, then we offer to move them into the renovated units. And most of the time, they're ecstatic to see these brand new units. They pay a little bit of a premium, and then we then go and renovate their vacated units. And on and on and on until we get through all of the units, which takes about 2 years. Mm-hmm. Now, so at that 2 years, we're ready to either refinance or sell at that point, and we'll look at the market to see how it's doing. So really at that, about the 3-year mark, we're like ready to sell. But we say 5 years to give ourselves a little bit of a buffer in case we need that extra time. And then we give ourselves even an extra buffer beyond the 5 years, because often we're getting a loan that's at least 5, if not 7 or 10 years. So if at that 5-year mark, we look around and see that the market is soft, then we'll just hold it for another year or 2 years, and we'll then sell when the market comes back up.
Mm-hmm.
And so let's say a person gave you $50,000 and was like, I'm going to need that money in 5 years, and they want to pull out at that point. Are they restricted from doing that? What's the terms there?
So when you invest in a real estate syndication, you'll sign what's called a private placement memorandum, a PPM. And in it, it spells out all the risks that you're taking, and it spells out the fact that your investment is illiquid. Because can you imagine if hundreds of investors each wanted to pull their $50K out at different times during the 5 years? It would be impossible.
Right.
And so we make sure that going in that this is money that unfortunately you're not going to be able to touch until we exit the deal.
Right.
So if it's money you're going to need for your kids' college tuition or for kitchen renovations or anything like that, then we always advise people not to invest with that money.
Mm-hmm.
Okay. No,
so it should be money that,
clear up front and
that you don't have any plan for immediately.
Right.
Right. Mm-hmm. But also there's so much upside, so much more to gain than a traditional investment.
I was curious, in this model where you offer to the existing tenants the option to upgrade to a better unit, do you say you can do that or you have to leave? Can they say, you know what, I'm fine with my unit. I want to stay in the, unfixed one. How does that work? I'm curious.
Yeah. So typically we do not offer to renew their lease. So the option is either they can move into the renovated unit, or we work out a time for them to find another place to live.
Okay. That seems fair.
And Annie, so you're kind of saying, I feel like you, in terms of Goodegg Investments, you are kind of finding the people with money who want to invest in real estate passively, and you are finding the people who are doing deals and linking the two together. Is that true? Or are you actually like a general partner managing the syndication?
Well, we are a general partner on all the deals that we do. But yes, we are the connector. We're the conduit between our investors and these great deals.
Okay, so you guys are actually managing the deal, like what's going on with the deal.
Yes and no. So I would say we're not as hands-on as a true asset manager. So on these teams, there is typically a designated asset manager. So we are not that person. There's somebody who is working day in and day out with the property manager to renovate the properties and execute on the business plan. Our main role is we'll come in at the beginning to help raise the money needed. We'll help to structure the deal so it's attractive to our investors. We'll help with some of the due diligence, and we'll help with some of the oversight throughout the deal, but we're not in the weeds with the day-to-day.
Okay, I think that's enough about syndications.
But you work for yourself, basically.
Yes.
You work from home. And
Yes.
Does your husband work from home?
No, thank goodness. So he technically could work from home, but his brokerage has an office that's, a mile from our house. So he works there, and I get to work from home, which is it's so great working from home. I used to work, I mentioned I live in Oakland, but I used to work at LinkedIn. And my office was in San Francisco, which would take me 45 minutes to get there. But then my extended team was down in Sunnyvale, and it would take me 2 hours door to door. I would get on my bike to the BART into the city, and take the shuttle down to Sunnyvale.
Oh, boy.
And so it was 4 hours on the road when I did that. And I did that until I was 8 months pregnant with my second child. And then I did it even after that with, breast pump in tow,
Yeah.
Yeah, it was.
That's exhausting. That's a huge bite out of your day. 4 hours.
Also a good time to take a nap, though, on those company shuttles.
That's true.
Yeah, I van pool, so I always take advantage of that 45-minute van pool commute to nap.
Yeah.
Nice.
So there are some perks to a longer commute, but I'm guessing, in switching to work from home lifestyle.
There's a lot more flexibility in that. How do you kind of arrange your day? Is it purely focused on the syndication deal? Is there other things you can do to kind of enhance your life or live more on purpose?
Yeah, one of the biggest benefits is I can chaperone every field trip. I can volunteer in the classroom when I want to. I can be there for the after-school activities. I can schedule my work to fit into those gaps in between rather than the other way around. And this past summer, because both my husband and I have location-independent jobs, more or less, mine more than his, we did a month-long home exchange. So we went to northern Spain, and we found a family there who wanted to come to the Bay Area.
Oh, wow.
So we swapped homes.
That's crazy.
And they have 2 little girls, the same ages as our 2 little boys. So we even did a car exchange, and they had car seats, and they got to use our car, and they had toys. So it was so perfect. And then they gave us a guide of all their top things to do with kids in the area. And because we were there for almost a month, and with a car and with car seats, we were able to take our time, not have to rush to see 10 things in one day. And we got to see a lot of the little towns that we otherwise would have missed. So it was a really cool experience. Every day we woke up with the thought, let's have an adventure together. Work was sort of on the back burner. It was like something we did at night when the kids were asleep. But we woke up every day and we thought, okay, what are we going to do today? So some days we would go hiking. Some days we would go to an art museum. Some days we would rent a boat and go kayaking. It was just all in the name of trying something new together as a family. And that's what I love about spending time with my kids, is showing them new things and watching through their eyes.
I love
That's
that.
so cool. How did you even
find? How did you find
that?
this arrangement?
Through homeexchange.com.
Wow. Have you done that before, or this was the first time? And would you do it again?
That was the first time. And I don't think I'll ever know people quite like I feel like I know this family. Because even though I've never met them in person, I've lived in their house.
Right.
I know where they keep their knives. I know like where their extra towels are. Like I know everything like about them and their space.
It's like a wife swap, but
yeah, it's
family
just like
swap.
yeah. It was a really unique way to get to know people. And we are definitely doing it again. In fact, we've got one coming up in a couple months. We're going not so far, but we're doing a road trip up to Portland. So we'll be there for 2 weeks.
That's so cool. And so the way this works is their family from Spain lived in your duplex, your side of the duplex for a month. And they used your car and you used their car. Is there any exchange of money or just a net neutral deal?
No, it's just a trade and there's no money that exchanges hands.
Wow.
And we stayed in contact the whole time, messaging each other back and forth. And they would send us photos of their kids at our local neighborhood playground. It was wild.
That's so cool. Yeah, I've heard of families who like go out for a week on a vacation. They Airbnb their home for vacation, but doing like a trade deal, that sounds really cool and something to look into too.
Yeah.
That's really cool.
Very cool.
So what other, I guess, flexibilities in terms of, you have 2 young boys. How old are your boys? And I guess what else has this kind of life that you've kind of designed for yourself enabled in terms of how you want to raise them?
My older son is almost 7, and my younger one is 3.5. And, I mentioned when I was growing up, I didn't know anything about, my parents only taught me how to save. That was like the only money lesson that they taught me. But now if you ask my kids, they'll say, oh, my parents never stopped talking about money. Everything's tied to money. Because we always we'll tie everything back, and we teach them not only to save, but to invest and to give. And so our older son, who's almost 7, he saved up $100 and he invested it with us into a flip that we're doing.
Oh, yeah.
So we've been talking about it. It's in our neighborhood, so we drive by all the time. We've taken him in to see it. And at first he was like, this is boring. Where are all the floorboards? Like this he didn't say it, but he was thinking like, this looks like a piece of garbage. Like but then slowly as he saw, the fence was going up, the walls were being painted, there was a new kitchen going in. He was like, oh, this looks pretty good. And to know that he's got, even a small amount in there, he's like looking forward to it. He's like, oh, my $100 could turn into $200 or $300. And so it's just teaching them young, all these lessons that we're learning.
Yeah, that's so cool. It sounds like you have so much going on. Like to me, like you have, 30 units collectively. You have a flip going on. You're doing this passive investing, and you're running the company for helping to passively invest for others as well. Do you have any like particular mindsets or habits that have helped you kind of run it all and keep it all in balance? Anything you'd like to share?
Oh man.
What are all those post-it notes behind you?
Yeah, I was just I was looking at all the ones next to me to see if I have any cheat ones too.
But what's behind you on your door?
The ones behind me, believe it or not. So I mentioned I came from the design world, and in design we do a lot of, brainstorming and so when I first got into this space, before I even knew that we were going to call the company Goodegg Investments, before I even knew that I was going to focus on raising capital, I sat down and I forced myself to do a brainstorming session, which is what those Post-its are from. And I put down all the things that I wanted to accomplish with this venture. Things like creating a community of women in real estate investing. Things like, making it easy for people to understand what syndications are about. And so I've kept those up there, and it's really been fun to walk by and, with every passing month, I'm like, oh, Yep, we've done that one now, and we've done that one. And so it's pretty cool to see it all come to fruition.
That's
Nice.
cool.
Yeah, I think having a vision is so important whenever you start out any kind of an endeavor, just to keep yourself on track and to also, in the tough moments, know why you're doing something, that you don't lose focus. So that's a great tip.
Why is moms your target audience? Is it just because both of you are moms, or... And moms are more likely to invest with other moms, or the trust factor there?
It's a good question. I think the reason we're so passionate about helping other moms is because we've been in their shoes. We know what it's like to be crazy busy with work and also have to get dinner on the table and also have to schedule the babysitter for the weekend date night and also have to do the carpool and also have to bring in the brownies for the bake sale. Like, we've been there, and we've been in that situation where we're like, I can't handle this. Is there nothing more? Either I work my job or I quit my job and stay at home. But we had discovered this great vehicle to help people build wealth that also doesn't involve a lot of work. And we thought, how great would it be to be able to help other moms who are struggling, who are working really hard? And also the fact that there's just not many women in real estate investing. I think that's another reason we wanted to help moms, is because, most women are intimidated by finances and by investing. Right. And we thought, well, what a unique opportunity we have to really make this complicated topic of syndications, really make it super simple for people. And what's funny is that we target women and moms, but the guys will come up to us and be like, oh my gosh, I love your content. Like, I thought I understood it before, but now I really understand it.
Yeah, you have such a good way of explaining it, honestly. I've heard a lot of people talk about syndications, right, but a lot of things just in our conversation here alone, I've really just sunk in. So
exactly. We've talked to other syndicators, and they've tried explaining things, and it's like, I'm just going to nod my head.
Yeah. It's the teacher in me. Can't turn it off.
Nice.
So I'm kind of curious to know, because you it sounded kind of like a natural progression, your whole story of how you kind of grew the whole real estate business and now almost like an empire, I want to say. But like, when you meet a young couple, who's kind of has similar upbringing, not a real estate focus or anything, what do you share with them in terms of, kind of creating a life of freedom that you've kind of created and some more intentional life? What do you share with a young couple, or what's some of your best advice there?
I think the aha moment that I had was when I realized that my money could work for me, that I didn't always have to work for my money. Because growing up, I mentioned, my parents just taught me to save, and live within your means. And then, if you want a big ticket item, you got to save up for it. Then you spend it all, you go back to zero, and then you start saving again. Like, that was all I knew how to do. My mom had mentioned when I was younger, I remember she had mentioned, she's like, did you know there are some rich people out there who don't have to work and they just live off the interest from their savings accounts? Like, that's what she knew. And I was like, wow, they must have a really lot of money. And so I think it was a mindset shift for me when I realized, well, you don't have to be super wealthy to get to that point. You just have to know the right vehicles to put your money into and be very intentional with where you put your money. It's not that you have to live totally frugally. You can still spend extravagantly. It's just you have to be intentional with what you're spending on and what you're investing in and how you're growing your wealth.
Right. That's so cool. And I'm curious to know, in terms of your kids and how you're raising them, kind of teaching them about that investing that you kind of never had. And both of you, growing up or graduating with degrees and going into the corporate world, your husband computer designer, and then now both kind of more of an entrepreneurial field, him as a realtor and you running the syndication business. Are you encouraging your kids in a way to go the traditional college route, or what is your thoughts on that?
My mom is. My mom's like, okay, when you go to Harvard someday, you're going to have me over. And I'm like, oh. But no, I think my husband and I are both very open-minded. It's led us to where we are today. And so we want to instill that in our kids. If they want to go to college and become an engineer or a physician or an attorney, great. And then we'll show them how to grow their wealth through all these passive investments. If they want to be an entrepreneur, great. Same thing. We'll show them. The bottom line is whatever they want to do, we'll show them how to manage their money and grow their wealth. I think that's really the key, because what you end up doing with your life, you should be free to do whatever you want. Nobody should have to worry about money. It's just a lot of people don't know what to do with their money.
Yeah.
So with our kids, we try to give them all these opportunities. Like we've done lemonade stands, and I'll always remember the first one that we did. We were out there for about 2 hours, and we sold a lot. We sold a lot of lemonade, and we also had some nice passersby who gave us some donations. So we ended up with about $120 in cash.
That's a good lemonade stand.
That's a good one.
Yeah.
We're going to move to Cali.
So we were sitting at our dining room table, and we had all these piles of cash on the table. And my kids' eyes were like saucers. They were looking at these piles like, oh my gosh, we're rich. I've never seen this much money before. And then we started talking about, there was the price of the lemonade.
Nice.
And the cups and the napkins and that jug that we bought. And the signs that we made. So we started taking away the piles little by little. And then we said, remember we said we were going to donate some of the money to St. Jude. So we took away another pile. And we said, remember, you said you were going to split it with your brother. So we split. And by the end, each of them had I think it was like $10. And they were like, wait, what? And I said,
life.
That's what it takes to run a business. But then next time, your startup costs are going to be lower because you already have the jug now. And so it's like these little ways that we're trying to teach them what it means to run a business and how to manage money.
Yeah, that's so awesome. We've done the lemonade stand too, and it just clicks little by little. All these little things click, and you can see their minds churning and really starting to get a grasp of what it really takes to run a business or get money, or how much money is worth, what a quarter is, what a dollar is, and what that actually means to hold that, and what you can buy with it and make with it. So that's really cool.
Even just the idea that you have to be diligent and work your business. Like my son got bored after the first hour of doing his lemonade stand and decided he wanted to go play in the backyard. And then he comes back, he's like, how come no one's buying my lemonade? If you're not manning your workstation, no one's going to stop and buy it on their own.
That's exactly right. Life lessons.
Yeah.
Well, Annie, it's been so nice chatting with you. I feel like we had a really good grasp of what syndications are. If people want to learn more, if people are even interested in perhaps investing through your company, what is the best way to kind of get in contact with you, ask you more questions, and find out more?
Sure. The best place to go would be our website. It's goodegginvestments.com. And if anybody wanted to reach out to me directly, I'm at Annie@goodegginvestments.com.
Annie, thank you so much.